Every year, Americans lose billions of dollars to interest, not because they borrow more, not because they spend irresponsibly, but because of how their credit score is calculated. And for most people, the damage doesn't come from major financial mistakes. It comes from one small behavior that feels harmless at the time, a behavior that quietly raises interest rates, loan costs, and monthly payments, long after it happens. That's what this video is about. Because once you understand how credit scores really work, you stop paying penalties you never agreed to. Credit scores are often misunderstood. People assume they measure how wealthy you are, or how good you are with money. A credit score measures risk, specifically how likely you are to pay on time, every time, without exception. From a lender's perspective, income matters less than consistency. Savings matter less than predictability. And the single biggest signal of unpredictability is a late payment. Most Americans don't think much of it. A bill slips by, a due date is missed, the payment is made a few days later. But credit systems don't treat it that way. Once a payment is reported late, it becomes part of your permanent credit history. That single mark can reduce your score by 50 to 100 points, and it doesn't disappear quickly. In many cases, it stays visible for up to 7 years. That one moment changes how lenders price you. The interest rate on your car loan increases. Your credit card APR jumps. Rental approvals become harder. Insurance premiums may rise. Not because your finances changed, but because your credit profile did. Let's look at the cost. On a typical $25,000 car loan, a strong credit score can qualify you for a low rate. A damaged score pushes that rate higher. The monthly difference may seem small, but over the life of the loan, that difference often adds up to thousands of dollars. Credit cards are even more expensive. A lower score can mean double the interest rate. Balances grow faster, payoff takes longer, and more of your payment goes toward interest instead of progress. This is how people overpay quietly, without realizing why. The solution is not complicated, but it requires structure. First, every credit card should have automatic payments set to at least the minimum due, even if you prefer paying manually, even if you pay in full most months. Autopay protects your credit score from human error. It prevents one forgotten due date from turning into a long-term financial penalty. Second, control your credit utilization. Keep balances below 30% of your total available limit. Lower usage signals stability and control. And credit scores respond quickly when utilization improves. Third, review your credit report regularly. Errors are common. Late payments reported incorrectly. Accounts that don't belong to you. Balances that are outdated. Correcting a single error can raise your score faster than months of perfect behavior. This is not about optimizing every detail. It's about avoiding unnecessary damage. Strong credit isn't impressive. It's quiet, it's consistent, and it saves money over time by keeping borrowing costs low. If this explanation helped clarify how credit really works, this channel is built for you. We focus on practical financial decisions that reduce long-term costs and improve financial control. Subscribe, like the video, and visit the channel for more clear, realistic finance guidance designed for everyday Americans.